I want to talk about economics for a minute. Nouriel Roubini wrote a piece in The Guardian a couple of days ago. It's titled The Liquidity Time Bomb, Monetary Policies Have Created a Dangerous Paradox. And now, this is a little bit wonky, but I want to break it down and just try to make it as simple as I can. He says, because of the way that we responded to the financial crash of 2008, and by the way, this very much tracks my book, The Crash of 2016. He's essentially saying many of the same things that I was saying. That what we did was we did not, these are now my words, not Nouriel Roubini's, we did not fix our economic system, our financial system in the United States, or around the world for that matter, but I'm talking about the United States right now. We ended up with larger banks, not smaller banks. While Dodd-Frank was a huge big deal in that it gave regulators the power to do things. For example, Mary Jo White, who is the head of the Securities and Exchange Commission, I don't know if they have they've got to have a phone number where you can call and leave a message for Mary Jo White. The Securities and Exchange Commission has, under Dodd-Frank, the ability, she could simply write a letter or a decree or whatever it's called, you know, a thing that says that all publicly traded companies have to disclose any political contributions or efforts to affect politics. Right now, they can do it in the dark. They can do it in secret. So, you know, who is paying off these politicians to get the TPP through? Big corporations. Mary Jo White, the head of the Securities and Exchange Commission, could put an end to that right now. And I don't know, Shano and Danielle, maybe you can track down the phone number for the Securities and Exchange Commission. I would be pleased to put it on the air. Okay, thank you. But anyhow, as Nouriel Roubini is saying, I mean, that's just one possible response. What he's saying is that basically the way that we responded to the crash was we dropped interest rates down to basically zero so that banks could be liquid, so that they could have all the money they wanted. In fact, he points out that we either tripled or quadrupled our money supply during this, 7-year period now since 2008. And the consequence of that has been that companies are using this money to buy back their stocks rather than stimulate the economy, rather than grow the economy. That, you know, well, here's to quote Nouriel Roubini. He said, unconventional monetary policies have created a massive overhang of liquidity. Now, liquidity means, you know, available cash, right? But a series of recent shocks suggests that macro liquidity has become linked with severe market illiquidity. Now, what that means is that if you own stock, for example, or in particular less liquid things like bonds, via things like bond funds, and there's no shortage of them out there. Most people who own bonds don't actually own bonds. They own bond funds, TLT, TLH, all these, you know, there's a whole bunch of them out there. If you decide to sell, well, right now, no problem. But if there's a stampede to the exits, the prices will just collapse. He says, investors have reason to be concerned. I'm quoting Nouriel Roubini. Their fears started with the flash crash of May 2010, when in a matter of 30 minutes, major U.S. stock indices fell almost 10% before recovering rapidly. Then came the taper tantrum in the spring of 2013, when our U.S. interest rates went up 100 basis points because Bernanke said, well, maybe we'll raise interest rates. Or actually, he said, maybe we'll stop buying long-term bonds. Same effect. He says, likewise, in October 2014, U.S. Treasury yields plummeted by almost 40 basis points in minutes, when statisticians argue should occur only once in 3 billion years. In other words, this should not have happened. And the latest episode, he says, came just last month, when in the space of just a few days, the 10-year German bond yields went from 5 basis points to almost 80. So what does all this mean? It means that because and it's not just us, by the way, the Central Bank of Europe is doing the same thing. The Central Bank of Japan is doing the same thing. We are flooding the market, or at least flooding the banks, with free cash. and very, very large corporations. And these corporations are taking this free cash and acquiring massive amounts of debt in order to buy back their stocks so that their CEOs can take huge bonuses. But they're not building new factories. They're not developing new products. They're not engaged in R&D. They're not marketing their products. And they're not increasing the pay of their workers. Again, this is me talking, not Nouriel Roubini. They're not increasing the pay of their workers so that there's more demand for the products that they make. And then he gets into high-frequency traders. He said, high-frequency traders who use algorithmic computer programs to follow market trends account for a larger share of transactions. This creates, no surprise, herding behavior. Right, so you've got these computers that are trading millions of stocks a second or a minute, mostly at the beginning and end of the day. In fact, he points it out. He said, indeed, trading in the U.S. nowadays is concentrated at the beginning and last hour of the trading day when high-frequency traders are most active. For the rest of the day, markets are illiquid with few transactions. This is scary stuff. And then he talks about how, before the 2008 crisis, banks were market makers in fixed income instruments. And, in other words, they actually held assets, which provided liquidity. Now they're not. And then he goes on to say, there is more investment in illiquid bond funds, while tighter regulation means that market makers are missing in action. As a result, when surprises occur, Nouriel Roubini writes in The Guardian, as a result, when surprises occur, for example, the Fed signals an earlier than expected exit from zero interest rates, or oil prices spike, or Eurozone growth starts to pick up, the re-rating of stocks and especially bonds can be abrupt and dramatic. Everyone caught in the same crowded trades needs to get out fast. Herding in the opposite direction occurs. In other words, instead of everybody buying into the market, everybody's trying to bail out of the market. Herding in the opposite direction occurs, but because many investments are in illiquid funds, in other words, you can't just convert this investment into cash, and the traditional market makers who smooth volatility are nowhere to be found, the sellers are forced into fire sales. This combination, Nouriel Roubini says, I'm quoting, this combination of macro liquidity and market illiquidity is a time bomb. So far, it has led only to volatile flash crashes and sudden changes in bond yields and stock prices. But over time, the longer central banks create liquidity to suppress short-term volatility, which is what they're doing, by the way, the more they will feed price bubbles in equity, bond, and other asset markets. As more investors pile into overvalued, increased illiquid assets such as bonds, the risk of a long-term crash increases. This is the paradoxical result, Nouriel Roubini. Nouriel Roubini, by the way, is famous for being the guy who predicted the crash in 2008 and how and why it would happen. He says, this is the paradoxical result of the policy response to the financial crisis. Macro liquidity is feeding booms and bubbles, but market illiquidity will eventually trigger a bust and collapse. We have been warned by one of the smartest guys on the planet. And I got to tell you, Janet Yellen has got to be quaking in her boots because she knows that the minute that she starts to raise interest rates, everything is going to crash.